Welcome, and thank you for joining us for this month's edition of The Big Picture. In this video, we'll be discussing the stock market for the month of December, and we'll kind of take a look at how the stock market has done as well as the bond market and all kind of markets in between. Each month, I do these videos to give you an idea how the market has done, and the idea and the reason I call it The Big Picture is to allow people to understand that the market is going to be very volatile, and traditionally it will be, but you also want to take a look at the big picture, what the trend is, and to not pay attention so much as the on the day-to-day moves in the market. But you do want to be on the right side of that market. So this is what we're going to do, is give you an idea of what's happened for the month as well as what happened for the year. And I'll also give you a little bit of insight as to, again, I don't like predictions, and you'll see that on my blog and in my videos, but I'll give you an idea of what the trend looks like and what the markets might be doing for the next year or so. On the screen here we have is our first chart, which I've shown each month, and this chart is the various indexes that I follow, and this will give you an idea what the markets did for the month of December. The S&P 500 in the red was up about just on a half a percentage point, 0.44. The Dow Jones up 0.37. The small company stocks had a pretty good run for the month of December, but you can see how volatile they are. We'll show you in just a minute. They were up 4.52%. The rest of the world is not doing that great, and I've said this many times, is that right now the place to be has been the United States. In our models, we have pretty much avoided most of the international, if not all of the international market, just because of what you see here with the pink. It was down 3.48% again for the month of December. And the next chart, we'll look at the whole year and see how this worked out as well. The next box is the moderate allocation. This is a proxy that I use to give my viewers and my blog readers, as well as clients, an idea of what a good balanced portfolio would look like. This is from a company called iShares. They have an investment that has what I call a moderate allocation, about half stocks, half bonds. And I show this because I have gotten emails and I have a few people that watch the videos as well as on the blog that have 401ks and don't have any money invested with us, but they have a question. Usually their question is that they'll see the stock market up pretty nicely, but their accounts aren't moving that much. And it's usually because they're pretty well balanced, which they should be. And a balanced account won't rocket up as much as one individual part of the market. And we'll talk about that more in the next video for the year. But the moderate allocation was up 0.58, and a conservative allocation actually was down a little bit for the month, 0.18. The last box is the bond market, and it was up 0.37. So I guess the only two that really stand out here is the small company stocks really went straight up, and the international really went straight down. And this kind of reiterates that you don't want to have all your eggs in either this basket or this basket, because this could turn into this one day. So you want a kind of balanced account, and that's what these two kind of show. On the next the next slide, we have the exact same investment indexes, and those indexes will show what the markets have done for the full year, and we'll kind of walk right through each one of them. The stock market, meaning the S&P 500, was up nicely, 3.46% for the year, and the next one is the Dow Jones, up about 9.8. It recovered kind of nice. It was just not doing nearly as well as it is right there. The small company stocks are up about 5%, and if you recall in the previous video, it was up almost 4.52, and so you can see that just the 1 month of December made the year a little bit for the small company stocks, because without that they were only up 1% for the year, and that can show how volatile these small company stocks can be. Traditionally, they do better than most of the rest of the market, because small company stocks, you expect a higher return but more risk. The next bar is the international market. It's just not performing. It's down 4.53%. And as I mentioned a few minutes ago, my firm has stayed away from the international for most of the year, if not longer, and it's because of this. There was quite a bit weakness, so we have been hovering actually over in this direction, the large company stocks, a little bit of the small just for a little bit extra kick, but you can see it didn't perform too well as well. A good balanced portfolio did about 5.27% for the year, and a conservative did about 3.98%. And then bonds were up about 6%. So they had another good year. I've been hearing quite a bit. I get emails as well where people wondering, they hear on the CNBC or on the internet, they see where it says get out of bonds because interest rates will be rising. And I kind of agree that when rates rise, bonds will probably not be, long-term bonds will not be the place to be. But as a good example is that I often say, let the market tell you when to move away from the bonds, and until the bond market starts to slide, you still want to hold bonds. And this is a good example. It was up almost 6% for the year. And so a good balanced portfolio that will kind of look at most of this was up about 5%. So that gives you an idea of what the year was like for the market. But it was somewhat of a volatile year. I don't show traditional charts too often, but my next slide, I wanted to kind of give you an idea of the boxes that I show. I'll jump back real quick. These are kind of easy to look at. For instance, you can look at the S&P 500 and say up 13.46, investing with the rear view mirror. You say, well, I would have taken just putting all the money there. First, you had to know to do that because it well could have been a negative 4.53. But just looking at the 13.46, you're thinking you started the year and it was a straight line all the way to the end of the year at 13.46. And this chart I want to show is it's not really a straight line, and that's why you want balance. The red line is actually the S&P 500, and the blue line is the moderate allocation, about half stocks, half bonds. And you can see this is for the year of 2014. On the left-hand side of the chart, the stock market dropped right out the gate through into February, and then turned and shot up and started to kind of really run up. But you could see the wiggles all the way along, and it really fell off here in October. And so from the beginning of the year, you were up, and the middle of September, you'd have been up almost 11% in the stock market, investing all in the S&P 500. And within 2 weeks, that would have only been up 3.34. That is a huge drop right there. And then in a day or two, it turned around and shot right back up. And then we dropped in December and we shot right back up again. So when you hear the word volatility, that's what we're talking about, the ups and downs. And a balanced portfolio, which is the blue line, is you're going to see the ups and downs a little bit smoother. And the idea is to have a balanced account that will smooth that out, so you can actually stay invested and not all of a sudden say, okay, I want to get out, that's too much drop, and the minute you get out, the market just takes off again. So you want to invest where you're comfortable that these ups and downs will smooth the ride out and you won't feel so much pain. But I did want to show this chart to show how the market was very volatile for the year, and I do suspect we're going to see that even more so probably in 2015. Now we're going to move on to my point and figure charts that I like to show, and this is another method of taking out the volatility, and this will give you an idea of how the point and figure chart can keep you on the right side of the market. The middle of the chart, not the middle, but more to the right here where my cursor is, where the O's are, and then turn with the X's. That was that big dip you saw on the previous chart right here, and then we turned around and bounced and went right back up. The blue line is our support line, and that held. What that means is the market got there and immediately turned around and went back up. I didn't draw this blue line in after this happened. This has been here. If you've been watching my videos for quite a while, this blue line's been here. And so I kept saying we're going to touch it, and sure enough, we touched it and turned around and went right back up. We've been consolidating, swinging back and forth, and right now the market had a little pullback in January, and actually a nice pullback, and we turned and we're kind of moving back up. So we're kind of standing between the highs back in November and the lows here sometimes in October. So we'll kind of see what the market's going to do. But for right now, as this chart shows, we still have the trend from the bottom left to the top right. A little bit of volatility, meaning that the swings are going to be a little bit more. But we do want to watch this blue line, making sure we don't break it. If we do, I think adjustments do need to be made on portfolios. If you're not being invested with my firm, you might want to be a little cautious if you see that breakdown, and we'll be alerting our readers when that happens. The next chart is the same chart, the point and figure chart, but this is for the month. So this is a monthly chart of the X's and O's. And as I showed often, we had the big dips going back to 2000 and 2008. And we have this support line. We broke above that. And then we had new highs back in September. And we are pulling back, according to this chart. We pulled back in January, and we haven't had a reversal back up yet. Again, this is a monthly chart, so it really won't do a whole lot till the end of the month. But it is giving us a warning sign that we had turned into two O's. That's not too concerning for me quite yet. I watched the daily first, but we have a lot of support all the way back, and you can see there with a couple of the green lines that we'll have some support. I believe that will turn maybe the market around. We'll watch those as the market unfolds over the next year. My last chart is again a traditional chart. I've showed this, but this is probably sometimes in the middle of last year when I showed it last. And we have the two green mountains, I call it, at the top. And when the market pushes up and gives those two green mountains, somewhere in the future, we will turn and pause. I call it pause. We will rest. The market cannot keep running like it's running. It will turn around and rest. And I think we have a pretty good pullback coming. I'm not sure where it's going to be. I suspect that it will probably be somewhere close to the green line, which is what the breakout was from the drop of 2008. The one thing that is not alarming, but something I'm watching very closely. This is again a monthly chart. I'm not sure if I mentioned that. So each bar or candle shows what happened for the market, in the month of that month. So right now, this last bar is for the month of January. So you might want to go back and count these bars, but I've already done it for you. And if you see from where the cursor's at here, we are up 36 straight months without a closing before below the blue line. And that is as a record. That has not happened for years, and I'm still struggling to find the last time that happened, and it's years and years and years. On one hand, some people say that's alarming. That is alarming to some. To me, that shows strength, that the market is very strong, and that's good to see. But one thing is that the sun does not always shine, and the market will eventually turn and have to come back and rest. I think it will have a pretty long run. We're on a long run. The market will be doing an upward trend for quite a while, but it does have to pause, and it does have to break below this blue line sometime in the future. You could see we did it in 2011, and we did it in 2010, and so that's not a big negative. That's just something to watch. And once it's done and it finishes with that pause, I think we have more upside to go. So I don't like to predict. I just use history as a guide. And one thing is for sure is the market does not always go straight up. And right now it has just traditionally been going straight up. Even though if you watch the news, some days it shows the market down 300 points and you feel like that's, the earth is not going to turn the next day, and it will continue to turn, and then the market turns around the very next day. So I would suggest you do not watch the day-to-day stuff and continue to watch maybe our blog or these videos and look at the big picture. And the big picture pretty much says that the market had a pretty decent run for the month. And I was trying to go back to this chart. This is the year of 2014. The market overall had a pretty decent year. A little bit of volatility in there, but it's still a good year. And we could well see the same thing for 2015. We'll have to wait and see. But please stay tuned and follow our videos. If you have not already subscribed, you can subscribe on YouTube, or you also can subscribe if you're watching this on my blog by using the links you see there. As well as if you enjoyed this video, please share through social media. We have the buttons available. We would appreciate that. If you have any questions, just hit the contact button, pop me an email. I answer all emails, and I'll try to get that answer for you if you have a question or even a comment. Thanks for watching, and look forward to talking to you next month. Take care.